The other interesting category, of course, which I love personally a lot, and I have a lot of my own money in it, is called multi-asset.
Yes.
Because I'm a big believer that having investments in different assets gives you a great outcome over a period of time.
Yeah.
So normally what happens is typically when equity does well, debt doesn't do well. When gold does well, equity doesn't do well. I mean, of course, last 1 year, thanks to a lot of the international tamasha which is happening, all those equations are getting a bit broken.
Hello everyone and welcome to Market Pillars Uncovered. And today we will be in conversation with someone who has had a very illustrious career in the world of the equity markets. We have with us Mr. Raghav Iyengar, who is the CEO of 360 ONE Asset. Thank you so much for being with us today.
Thank you so much for having me, Mubina.
So in today's episode, we're going to deep dive into education when it comes to mutual funds. We'll also be talking about alternate investment funds, portfolio management services, and understanding in depth about how investors can really leverage these opportunities in order to build their wealth, what is the right entry point, exit strategies, and identifying how to really make the most of it. So thank you for taking time out. But before I get straight to it, to what investors really want to hear and what everyone on the show wants to hear, I want to talk about your very illustrious career, because you've of course worn many hats. But tell us a little bit more. How did it begin as a young Raghav Iyengar?
So I'm an accidental mutual fund guy. I am a chartered accountant by qualification. When I started my CA, I had no idea what mutual funds did do or what capital markets did. Obviously, being in Bombay, you do get exposed to stocks, but they were not as vibrant as they are today. And this is about 30-35 years back, right? And I just got lucky. I just got into a great firm which was starting operations. And at that time, I remember the entire mutual fund industry used to be like less than 1 lakh crores. Today, we are 70 lakh crores. So in 25 odd years, the industry's jumped 70 times. And then there's obviously a thought that it'll even go maybe much, much higher than where we are today. So even today, our indicators, if you compare us to some of the larger developed markets, I think we yet have a long way to go. The second thing which I keep telling everyone is that we are a young country. So as you get more and more younger investors coming into the market, I think this industry is just going to take off.
And you're going to be a part of this.
I'm going to be a part of it,
so that's great to know.
And I think a lot of that is happening thanks to a lot of what people like you are doing.
Yeah.
Because I think in today's world, I think the one thing that's happened thanks to the internet is that now information is democratized.
Yes.
You don't have to be sitting in Bombay, Nariman Point or Dalal Street to be to have that information. You can be sitting
in a
finger. You could be sitting in some railway station.
Absolutely.
You could be sitting in an office, maybe in Darbhanga, for example, and you could be as smart or as knowledgeable as anybody.
And still making the lakhs and crores. Which is something that 360 ONE does brilliantly. Not even in lakhs, I should say. But you guys have two verticals. There's wealth, and then there's, which is I think the sexier side of the business, as you said. And then there's asset. Tell us a little bit more about asset and what you guys do.
So asset simply is that we have two businesses within assets. One looks at unlisted assets, which is largely our alternate investments funds franchise.
Okay.
And one is the listed business, which is mutual fund, portfolio management, and alternate services there. So it's essentially most business guys have one CIO. I'm blessed to have 4. So we have obviously Anup, who runs our entire listed market vertical. We have Samir, who looks at our private equity. We have Akash, who looks at private credit. And I have another gentleman called Neeraj who looks at real assets. So in some sense, we're a full service shop. So anybody who wants any type of asset can literally come to us for advice or for participating, and we're there. And we built this over a long period of time. So I think we are now possibly India's largest private equity franchise. We have possibly one of the largest credit franchises, which is again picking up what you call performing credit. Of course, on real assets, we're really recapitulating, doing a lot of interesting things there. And of course, equity is something that we do very well. So I think
absolutely, and kudos to what you guys have built. So let's just get down to the basics. If we were to explain to investors different types of mutual funds and what sort of mindset, risk appetite, or type of investor they're typically suited for.
So one thing which most people don't understand is they think even today, after my being in the business for 25 years, people yet feel that mutual funds is equal to equity.
Yeah.
It's actually not. I mean, you have mutual fund schemes which are available for like 2-day investments. We call overnight funds. 15-day investments, they're called liquid funds. And then you have a whole ladder that goes up.
Yeah.
And I think the good thing which has happened is that the regulator about 5-6 years back came out and sort of standardized everything. So now you have various categories. You have a large cap category, for example, which essentially those schemes invest in companies which are very large, top 100. And you have mid cap, which is 101 to 250. What also all this does, of course, it gives you a good idea where to go to, but in the process you get reasonably confused, especially if you're a first-time investor, you don't know what to do. And again, that's where I think things like what we are doing today really helps. But if you were to ask me, I think the start of any journey from an equity perspective should be a flexi cap fund.
Okay.
So flexi cap is, if you go back and you play chess, the queen can go in any direction. So flexi cap is very, very similar to that. I think the fund manager can essentially buy whatever size of company, whatever proportion he or she wants to buy. The other interesting category, of course, which I love personally a lot, and I have a lot of my own money in it, is called multi-asset.
Yes.
Because I'm a big believer that having investments in different assets gives you a great outcome over a period of time.
Yeah.
So normally what happens is typically when equity does well, debt doesn't do well. When gold does well, equity doesn't do well. I mean, of course, last 1 year, thanks to a lot of the international tamasha which is happening, all those equations are getting a bit broken. But if you take over a 15-20 year period,
yeah.
So if you have, now you can do that yourself by putting money into various things. My father, for example, is a great example of that. So he's got his own small equity portfolio. He's obviously got a good mutual fund portfolio. He's got a small property portfolio.
Well, he's being advised by the best.
No, he's not. I think he's done it on his own. And So in fact, most of the times I go to him. No. So that's one way to do it. The other way to do it is if you're a lazy investor like me, you just put it into a good multi-asset fund and let the mutual fund manager take that call. So I think these are two lovely categories that one must have.
So I want to just deep dive into multi-asset investing, because I think there are a lot of people as well who say, I want to take a back seat. I want someone else to do all of the hard work. I don't have the scope, the bandwidth to deal with all of the information. Like you said, we have so much information today available. So would building a resilient portfolio definitely involve a multi-asset fund in it?
I would think so, definitely. Because I think, like I told you before, I think different asset classes, performance moves in different directions at different points of time. It's very, very difficult sometimes for an investor to move out of, say, equities at the right time, get into gold, maybe get out of gold at the right time, get into silver. And today the regulator has given us flexibility to do a lot of things under multi-asset. So I can do equities, debt, gold, silver, real estate investment fund, investment trusts, and of course offshore equities. All this is available. So in some sense, it's a sort of a one-stop shop, which sort of then does everything. Number two, very nice, interestingly, it also helps from a tax perspective.
Yeah.
Because if you were to do that on your own, you will pay capital gains tax or on the profits that you make. Whereas if a mutual fund does it within the scheme, there are no taxes.
Okay, so those are all of the advantages. But I guess I want to understand the distribution of within mutual funds, because I mean you have to look at size specific, sector specific, etc. Can you give us a sense as to what do you think the basic criteria would be, or how you perhaps allocate your money across different mutual funds?
I think one interesting thing is I've learned in my now 25-year plus is that there's no sort of formula for investing. I think each investor is pretty much unique, right? And of course, you have the old cliches which are that 100 minus your age and that much of money you should keep in equity. I think, again, to take it back to my father's example, he's 80 plus, but he has a very healthy equity portfolio.
Yes.
Now that's very contra to what people would think, that hey, 80-year-old guy should be putting all his money into super safe stuff. But I would put it the other way. I said there's a certain amount of money which I don't think he's ever going to need. That money is in some sense lifetime money. So I put that away for equity. So equity, for example, is very critical if you have time on your side.
Yes.
So I would go the other way around. Typically this equation would say 100 minus 30, 70% should be in equity. But just think of me, I'm a 30-year-old guy, I've got a housing loan, car loan, maybe just got married, just started a family. I can't put 70% of my money into equity, especially if I need it for something down the road, right? So I think time is very important. Number two, ability to see volatility is very critical. And I think that's very individual.
Yes.
Because many investors get very frightened with 5-7% drop in their principal.
Yeah. So that boils down to your risk appetite.
Absolutely. Yeah. So which I think now the regulators again done some very interesting stuff. So you've got schemes which tell you how risky, how not risky. Yeah. And you can try and marry that to get yourself a good outcome. So yes, you need to do little bit of work in the initial stages. Try and figure out, there are a lot of these things available, testing your risk appetite, which tells you what type of an investor you are. Do that little bit, figure out how long your money is for, and then enjoy the journey.
Okay, enjoy the journey, and I'm sure a lot of investors will be doing that. And let's talk about the 361 Quant Fund as well. And that has delivered something like 29% returns over the last 3 years.
Oh yes.
What is the philosophy? What is the investment style? Can you tell us a little bit more?
So it's actually very interesting. It's emotional and independent. So I call it in some sense an auto fund.
Okay.
So what we've done in 361 is that we have a framework, one called SCDV. So secular, cyclicals, defensives, value traps. So if you look at a quadrant, these are the 4 quadrants. If I put the base, any company which qualifies has been able to do 15% PAT growth, profit after tax, and has a return of equity of over 15% in the last 6 to 10 years, qualifies as a secular. We would like to obviously be there, but obviously that's subject to price and other things in life. If a company's got the ROE part, then he comes in as defensive. The company's got PAT, profit part, he comes as cyclical. These two we rotate in and out depending on where where we feel there is investment opportunity, and value traps, which is none of these two, we try and avoid. Now what Quant does is very interesting because it just takes the entire BSE 200, gives it a momentum score. We look at the stock based on its momentum.
Okay.
So you get a certain number of stocks, and then we buy stocks in that fund only which are secular and defensive. So one is Quant, our 360 Quant doesn't go into technically small caps because our investment universe is the top 200, the BSE 200. And then within that we put this secular and defensive layer. Number 3, we put a limit per stock, which is about 3% per stock. Number 4, we don't go plus minus 5% of the sector in the index. So let's say financial services hypothetically is 15%. The portfolio will at all times have 10 to 20%. So with this combination of factors plus, so there is a little bit of, there is a passive element, which is because the portfolio is getting constructed using a momentum formula, but there is an active element which is all the secular, defensive, and all the other things that we do, and that outcome is what you just read out. So it's been a great journey.
Absolutely. And to add to that, there's also been the balanced hybrid fund.
Yes.
I just want to understand a little bit more in terms of tax efficiency, in terms of asset allocation. How exactly does that work?
So it's a very, very simple fund. I don't know if you remember the old Parlay ad, Crackjack 50-50.
Yes.
So this in some sense is pretty much that. 50% debt, 50% equity. The equity moves between 40 and 50 typically based on a valuation criteria, which is in our case is the price to book. So if the price to book, for example, is beyond 3.5, 4 times, it will be lower equity where it is today because markets are unfortunately or fortunately a bit expensive. And the remaining part is high quality debt. And that's the taxation is actually become much simpler today because in 23 the government came up with the new tax rules. So any mutual fund which has non-debt of 36% and above qualifies for 12.5% capital gains tax plus surcharge if you hold it for 2 years. So in equity you'll hold it for a year, but if it's over 65, but anything else you hold it for 2 years, which is the thing. So I think from a taxation perspective, it's very efficient. From a risk reward perspective, it's great because if you see especially the way markets have been moving last 1 year, I mean April to September was a great period, October to March was not a great period. Again, April was a really bad month. May is turning out to a better month. So when this kind of volatility, investors get a bit worried, especially the newer people. So this product is ideal for somebody who's got a slightly shorter horizon as compared to equity, or who's a bit worried about, just too much volatility and is really worried about capital losses. Then I think that this sort of helps.
Then go the crackjack way.
Then go the crackjack way, yes, absolutely.
Okay, you've been in this market long enough. I know you said that there's no one, size fits all. There's no real formula for investors, but I'm sure that there's certain factors when it comes to the mutual fund industry that you monitor continuously. What would they be?
Personally, I think there are a whole lot of things. I think this industry is possibly amongst the most transparent in the financial services industry. So I think we are proud to be part of an industry which I think is a global leader in transparency. Just to give you an example, we publish our portfolio right down to literally to the last rupee every 30 days, right? Once in a month. There are some large Western markets, and I won't talk about them, but they are really large.
Yeah.
And for the viewers, you can just Google it and see. You don't get that you get it once in 6 months. So that's one big thing, right? And then everything else is here. You have transparency, you have every over there. So I think the key thing for any investor in this business is not to get overloaded with the amount of information. The transparency also sometimes means that you've got a ton of information which you don't want to process. So I look at it if I were to talk about it from my personal standpoint, I think, as I said, do the first risk story first, figure out how long your money is. Let's say it's in a mutual fund, for example. I like to see how the fund is doing when the markets are actually going down or flat.
Yeah.
See, when it's going up, I think it's that the rising tide lifts all boats, right?
Yeah.
So it's just the funny part is when the tide goes out, is then you really don't know who's doing what, basically. So I think for me, that's a very, very critical thing. So if someone can just go back and look at numbers and see how their investments have done when markets have fallen, I think that's a first flashpoint. Yeah. Number two is obviously anything to do with governance, I worry.
Okay.
So and I think we have a very, very robust media. It keeps all the participants on their toes.
Yes.
So even minute information comes out. And yeah, if it's routine stuff, you shouldn't worry about it. But if it's something that you feel is very high governance issues, some scams, stuff like that, then I think I would be worried.
Okay.
Number three, of course, I think if there's just too much fluctuation in the corpus or too much fluctuation in the expense ratio. I mean, one month it's X and another month it's 2X. But small changes are okay. Those are some immediate red flags that I get worried about. And lastly, of course, if there's a change of promoter, which happens a lot in our industry, because the industry is very fluid, it's obviously better to watch at that time, because a change of promoter could mean a change of style, philosophy, which may have a negative outcome on your portfolio. So that's
those would be the red flags.
The top 3, 4. I really don't worry about 1 year performance being little off or anything like that. I mean, if I see persistent underperformance, 3 year, 5 year, 7 year,
that's when the alarm bells go off. Yeah.
So actually, I don't even bother about performance till it hits to a 3 year level.
Okay.
I think 3 years ke baad is when I will start thinking about, hey, if this fund is not doing well, then I may put it on a slightly more, what you guys like to call the watch list.
Yes.
And then if that underperformance is continuing, then I think it's time to maybe take some action. And that's the beauty again in our industry, because you can pull out money anytime you want.
Yeah.
It's great and it's good.
Yeah.
It's also bad because sometimes you make these emotional mistakes.
I actually want to come to that, because you're saying you can pull out money at any point in time, and exit is equally crucial to entry, right?
Yes, it is. Yeah.
So what is your, sort of a thumb rule or golden rule that you go by, or that you would advise investors? Because like you said, it can be very tricky business as well, exiting. So what is your sort of parameter or rules that you go by?
I think fundamentally, number one, just look at the taxation. Because I think there is, like, for mutual funds, as I said, if you're an equity-oriented mutual fund, till 1 year you pay the normal tax, which is your regular rate of tax, right? Short-term capital gains tax, which is much higher than long-term.
Yeah.
And then 1 year ke baad it becomes much lower. So I find many investors coming in 6 months later taking out money.
Yeah.
And you just realize that, hey, you paid out a huge amount of money just because you didn't stay that extra 4 or 5 months, right? So obviously one thing is try and figure out the tax, which is very easy, frankly. It's just 1 year, 2 years.
Yeah.
And I think most mutual fund investors today, at least in today's market, should come in and stay for much longer than that.
Absolutely.
Right? I think on the other side, on exits, I mean, I ask anybody as an investor, I said, why are you investing money? So I have a lot of people who come and ask me that, hey, we're starting our SIP and so I said, as a thumb rule, if you can save about 20-25% of your net take home, you're in a great place. If you can diversify it across 2-3 categories, you're in a great place. And then please just do your work.
Which categories?
My favorites are flexi and multi-cap. I mean multi-asset, as I told you. And then of course, if there are many young guys come and tell me that we like small cap, and I said, hey, that's a great place, but then don't look at it for 10 years.
Okay.
We like mid cap funds, but hey, super, but don't worry about it. Just be aware that mid cap and small cap can give you a nice roller coaster ride, right?
Yeah.
You're seeing it today because buckle up. So you have to be clear about it. I mean, the worst thing that you can do to your portfolio is buy high, sell low.
Yeah.
Because then you're constantly losing money, and then at some point you'll get frustrated. and then you may get off the entire investment train,
Yes.
which is not good for you in the long term, right?
Absolutely.
But yeah, the third thing is, of course, is that please spend some money. I think most people are great savers.
Yeah.
And especially guys like me, we make money, and I think it's important that if you kept money aside for a particular goal, like I said, I want to take my wife to Antarctica, right? It's really the end of the world. I mean, right? Literally. I mean,
Yes.
in all manner of speaking, right? And that's an expensive trip because you take a flight, you go all the way to South America, Argentina, and then you take another ship. And you do all that time pass, and of course there's a fair amount of money you'll spend to buy up the gear and everything. But yeah, I've saved up some money for that, and I'm ready to take her. But now I guess it's we have to make sure our diaries match. But what we tend to do, unfortunately, is we're going to spend so much money.
Yes.
No, let's not spend it. Let's just keep it for something else. I think that's important. And in some way in your show, if you can think about that,
Yes.
that you save but you must spend, because ultimately you're saving up to enjoy it and have experiences.
Yes.
Just looking at that account statement with all that return is not very important at the end of the day. Right?
Absolutely. Saving is equally important as spending.
Spending,
so I'm so glad that, we're sort of wrapping it up on this very informative note. I guess you sort of answered my last question, which is what you do in your free time. So apart from planning wonderful trips for your wife, what is keeping you busy?
No, I do a lot of reading.
Yes.
Because I travel a lot. So I think reading is something that it's a great way of spending some time.
Yes.
And obviously I do the normal things that everybody does. We watch movies, we go on holidays.
Lovely.
I do a bit of, I used to do some sports, but of late I just like to walk.
Okay.
I think walking is meditation in motion.
Oh, absolutely.
So it's a great way to sort of keep yourself fit and
Yes.
also get your brain a little loosened up.
Yes.
But otherwise, it's just fun to be in Bombay. Yeah, that's it.
It absolutely is. Here's the maximum city where everything's at, and you're at the center of it,
Yes,
in the heart of finance.
Yes.
So thank you so much for
Thank you.
joining in. It's
Thank
been
you.
wonderful talking to you. I think you've really opened our eyes to so much that's happening within the mutual fund industry, risk appetite, spending, saving, the different types of funds, red flags, and all the wonderful things that you guys are doing at 361 Assets. So good luck with
Thank you. And good luck to you too. I think I'm very happy that
Thank
something
you.
like this is happening.
that. Yes.
And someone senior like you is really anchoring this. So all the best for the show.
Thank you so
Thank you.
much. So kind of you. Well, with that, we wind it up on this edition of the show. I hope you enjoyed watching. Do share some of your key takeaways or what you would like to learn in the next episodes in the comments section. I hope you found this as insightful as I did and actually start saving and spending and not just looking at your bank statement piling up, which hopefully it is. Thank you so much for watching. Do remember to subscribe to Money TV.